Hello, investors. Thank you so much for tuning in. I try and upload this on a Friday, approximately 9 a.m. Eastern Time. So this is episode 16 of how to invest, and it's kind of an interesting period, right? I call this a 3+1. Going to go through three topics that I think are interesting for people in the audience, and then then talk about the book recommendations at the end. So. I'd just like to say thank you because there's a lot of people that have been kind of following now and kind of engaging with the channel, and it's kind of really reassuring to see that because in this period right now, it's quite a small channel. I've only got about 2,000 followers, but I've got a few names that kind of show up regularly, and I'm really grateful for you people. Thank you so much for giving me your time and interacting with me and asking me thought-provoking questions. Okay, so without further ado, growth is dead, and how do I feel about it? So in the past 2 months, it's been a consistent drawdown in a lot of growth names and a few things that I wanted to kind of highlight. It's kind of interesting. It started off with just kind of a few names, let's say Snap was one of the kind of the first ones to get hit hard. Another stock that I owned that got hit quite hard was Upstart. That's still getting hit really hard, but now it's like contagion. It's kind of just got everywhere, Peloton, Zoom. Pinterest got killed really quickly as well. There's so many of them. It's just like it's been unrelenting. And it's not only, I hear a lot of people say that, oh, if you're just investing in one space, you're going to expect to get killed. I'm not just talking about SaaS names here. It's advertising stocks. It's really broad in terms of the areas that are getting hit really hard. And within these growth names, it's really like the mid caps, really, because if you look at, let's say, Apple, or you look at the other mega caps like Amazon and Microsoft, they're doing really well, man. And if you're comparing yourself with the S&P as I do, and it's been a really difficult period, and everyone's saying, "Oh, the market is trading at all-time highs. The market is so strong," and I'm like, "Oh yeah, not my market. No, not my market at all." So it's kind of an interesting dynamic. And for me, I'm actually quite compelled about that because I think it's really healthy for a market to go through this period. And I know that nobody wants to see market sell-offs, but if the market didn't sell off every so often, then it's not a healthy market. It just defeats the whole purpose of having a market. A market is being able to people to raise capital, and it's just not helpful if you have a market that is totally out of control. So I recognize fully that nobody wants to go through the pain, but being able to go through this period is actually really, really helpful. And if you can, I know it's really difficult, but if you can, try your best to think like a business owner. Now, by that I mean, don't be looking at the share price every single day, but just try, if you can, to think like a business owner and understand how your businesses are performing. And don't look for the share price as validation of how your businesses are performing. So, for example, spend a bit of time going through the notes. I always say to people, just write 2 or 3 notes about your business so you understand why you bought the shares in the first place, and try to think about how the businesses are performing and what are the positive opportunities here. So a lot of people that kind of watch this channel, they kind of have more than a passing interest in investing. So rather than just looking at the share price all day and just like going through Twitter and stuff like that, although there is a lot of interesting stuff on Twitter, but try to think about what the business is doing and try to read around a little bit about that. I think that's quite helpful for me as an investor. And also to understand that the market doesn't know the price that you paid for your stock. Let's say that you invested in Upstart or something similar, the market doesn't know that. And just because you bought at a higher price, everyone's going to think, oh, it's going to take a really long time for me to come back to break even. And people get really emotional about that and take it really personally. And it's just, it's the market is very dispassionate. And if you're right on your investment in time, the market will reflect that. And you just have to kind of have these periods where you just sit on your hands. And it's as difficult as it is to kind of to say that, it's easy to say, difficult to do. That's just the process you have to do. You have to be willing to take a long-term view of investing, and everybody kind of understands more or less that stocks go up as well as down, but everyone kind of just forgets the second part of that, the down part. And I feel that it's really, really helpful to take a step back and understand that this level of sell-offs don't typically last for a very long time. They kind of, most sell-offs don't last more than, let's say, about 18 months, and it doesn't continue at this pace forever. So from the top to where we are right now, we've kind of gone over the majority of it already, and many of the stocks already now kind of trading at a very large discount to what a reasonable person would call intrinsic value. Um, yeah, so that's one of the things that I wanted to highlight. The other thing that I wanted to highlight for you is a little quote here that, if this moves forward, just a second, please. Okay, yeah, so this is something that I wanted to share with you. So this is a quote that I have from Epictetus, if I'm pronouncing it probably wrongly. He's a Stoic from about 2,000 years ago, and it's quite an interesting story. So he became a Stoic, and it's quite interesting because he's actually, a really wealthy person. He was a very famous and wealthy individual, and it's quite interesting how he decided to be a Stoic. And there's a book that that discourses where he kind of talks about what it means to be a Stoic. And this is one quote that I kind of wanted to share with you. So, eat like a human being, drink like a human being, dress up, marry, have children, get politically active, suffer abuse, bear with a headstrong brother, father, son, neighbor, or companion. Show us these things so we can see that you are truly have learned from the philosophers. And what that quote is saying is like, it's easy to say that you're going to be a philosopher, but when you're in the heat of the moment, show that you can actually be a philosopher. And I've extrapolated that to investing because Charlie Munger always talks about have a multi a multi-lattice framework about investing, learn different mental models, and look into philosophers and look into Stoics particularly how they've incorporated and dealt with setbacks and how to frame your mind to absorb that. So it's one thing to talk about being a value investor or growth investor. It's quite a different thing to go through that. And I think that this is really helpful to understand that, thinking like an owner of the business and understanding that, okay, businesses are a bit like human beings, even if they have, a bit of a period where they kind of fall down, most of the times businesses get back up. And that's really something that's quite important to figure out that even if you have sometimes a bad quarter or if the market is having a bad period, just a temporary setback, and that it's absolutely normal to go through these periods and look at it in a very rational way and don't try to kind of extrapolate the value of the business relative to the share price. Just because the share price is going down all the time doesn't mean that the value of the business is going down all the time. And so when you think about it, right? So share prices, everyone kind of understands, okay, if you buy something at a discount, over time it'll catch up with intrinsic value, and sometimes it overshoots intrinsic value. But when stocks go on a discount, everyone's like, yeah, stocks on a discount, but nobody really wants the stocks to remain at a discount. And I feel that getting that framework in your mind that the way to navigate this period is to use this period to add small amounts to your portfolio because you don't really know how long a sell-off can last. So let time do its things and space out your investments into your portfolio about 4 to 6 weeks apart and try, if you can, to spread it evenly across your portfolio. And I say that to spread it out by about 4 weeks apart because I always say, you should look to it's the time spent in the market, it's not timing the market. So don't look, oh, the share price is down, I'm going to buy in now, I'm going to go double down on my position right now, because you don't know how things are going to unfold. Sometimes things sell off and they remain irrational for a lot longer than you can remain solvent. And it's important to position yourself and to think through all this in a logical and rational manner. So yeah, that's the next part that I wanted to kind of talk about. And the other one that I wanted to talk about is a lot of people say, oh, Michael, should I leave some cash on the side right now? So So there's a quote from Warren Buffett that he put in the Financial Times, and he talks about people get smarter, but they don't get wiser. They don't get more emotionally stable. All the conditions for extreme overvaluation or undervaluation absolutely exist the way they did 50 years ago. You can teach all you want to the people. You can tell them to read Ben Graham's book. You can send them to graduate school. But when they're scared, they're scared. And I think that's really helpful to think about because it's just the emotions that kind of run through the investment psychology. And it's so interesting when I look, for example, at how back in the, let's say, in 2020 and into early like 21, everyone's like, okay, I want to invest at any cost. Everyone's saying cash is trash, and people were just saying to me, a lot of people were saying around November, December time, oh, I wish that I'd put more stock at the trough of March 2020. I knew it was a good time, but I was kind of waiting on the sidelines, and I was kind of like. I wish I'd put more money to work then. And I'm like, yeah, it's easy to say now when it's kind of really easy and all it's very the water is very warm and it's cozy and the outlooks are all good. And it's easy to say that then. But I said, if you reverse the clock, you would have just been the same, because people's temperaments, you kind of, it's one thing to think that you know how to go through sell off, and when you actually go through sell off, it's totally something totally different. So right now that the person's in a sell off, I bet that same person is the same thing, cash on the side, cash on the side. And it's really kind of interesting because the time to put cash to work is when you are on the sell off, right? So now is the best time. Doesn't mean that you're going to get the bottom tick on any of these companies, but to kind of keep cash on the side right now doesn't make a lot of sense to me. That doesn't mean you kind of go all in right now. I personally like to be fully invested all the time. And when my salary comes in on the first of each month, I kind of put that to work. But I have a big stack of cash that I keep it as my personal balance sheet so that, so that I don't need access to my stocks for about 18 months, So if things kind of go slightly mad for about 18 months and I lose my job or something like that, I have enough cash on the side to kind of be able to ride that out because you just never know. The worst thing would be for you to lose your job or whatever, lose your source of income, and then you need to go to the capital markets and kind of join a sell-off. Because that's right, the Charlie Munger talks, whatever you do, the first rule of compounding is don't interrupt the compounding. So I personally like to be always fully invested, and you might not feel very comfortable with that, and that's fine. But to remove cash, to remove cash to the sidelines right now doesn't make a lot of sense to me. I hear a lot of people saying, "Oh, I'm just going to exit the market and wait for a better time." There's never a better time. There's always something to be worried about in investing. This is just that's how it is with investing. It's never perfect. The conditions are never perfect. And there's a Peter Lynch quote that says that more cash has been lost from the anticipation of a correction than during a correction itself. So if you're not going to invest now, I mean, when is the best time to invest? I think that pretty much kind of sums it up. So yeah, I've already kind of touched this slightly about this, but that when everyone wants to kind of, everyone's like saying, I read the comments on Seeking Alpha, it's like, go back, read over some of my previous articles, and I see people say, "Oh, I don't want to buy XYZ stock at, let's say, at $100. I'll wait until it's at $90." And I look at it now, it's like at $60, and I'm like, I wonder if that person was really able to have the conviction to buy it at 90. And so what? You missed all the up when it went up, and now that it's kind of crashed down, you're kind of like, are you going to invest now? Probably not. You're probably still not going to invest. So the way to think about investing is just to stay the course for as long as you possibly can. And yeah, I think that's to position everything in your personal life so that you can survive and stay in the market. And I already talked about this, how get your balance sheet, your personal balance sheet in order, pay off your credit cards so that when you put capital to work in the market, you don't have to touch it for about 18 months or so, because the worst thing to do is to kind of interrupt the compounding, because businesses compound, over time, and sometimes the share price kind of goes ahead and sometimes it goes below it, but you have to align yourself with the growth in earnings of the company over time. And That's the best way to really think about that. Um, so I'm kind of going to go through three book recommendations that I think are helpful. And yeah, if you let me know if you enjoy them or not. So this book that I'm reading right now, Noise, Kahneman and some Daniel Kahneman and some other authors, I think they came from Nudge. Yeah, it's an interesting book. It's not as good as Thinking Fast and Thinking Slow, although people really rave about it in the Amazon reviews. It's kind of there's some good aspects and some bad aspects. The one thing that found really helpful is this idea that let's say that you they talk about the Francis Bacon experiment. I think it was early 1800s that they have to go to Market Square and you have to. I'm kind of paraphrasing this slightly. Francis Bacon says, okay, this hog pig, how much does it weigh? And they're like, oh, I can't remember the exact numbers. I'm just gonna make this up. I don't even know what the pounds are. But it says like, oh, how much does the hog weigh? And the there's about 800 people on the market square, and they all kind of put their little vote of how much it weighs, and everyone is independent of each other. So you're making an assessment independent. You don't know what the other person has made, and you calculate how much the hog weighs. And as a group, they came very, very, very close to what the actual weight of the hog was. And this sometimes people nowadays, the modern experiment is more the jelly bean counter. You kind of put a jar of jelly beans, and everyone kind of makes an estimate of how many jelly beans there are. And that's something that kind of the wisdom of the crowds. Now, what Kahneman also talks about, which is that if everyone kind of confers with each other, and I know what person A has said, and person A knows what person B has said, and person B knows what person C said, we influence each other, and the bias that we have moves in a certain direction depending on what everyone else has done. Now, what Kahneman refers to in some new research is that if you go through and you make an assessment of what, let's say, the hog or the share price is worth, and you pause for 3 weeks and you reassess a brand new estimate, and take the average of your first and your second estimate 3 weeks apart, the average of those two is actually much, much closer to the actual accurate result. And he says that if you haven't got time to lay out 3 weeks apart an estimate, if you try to put down an estimate and then you try to counter argue against yourself and come up with a fresh estimate of why estimate one wasn't particularly right and come up with a new estimate and then take the average of the two, that comes really, really close and significantly closer than you just doing an estimate on yourself. So the way that I do this in practice is I found over time that my best results have come from when I've looked at a stock and said, I don't want to invest in this. It's too expensive, or this doesn't make sense. This doesn't make sense. And then I keep following the company over, let's say, a quarter or into the second quarter, sometimes a bit longer than that. And at the moment, it clicks in me. I'm like, actually, I've been totally wrong on this, and I've reversed my opinion. And at the point that I reverse my opinion and kind of go long that position, that's when I really kind of get some of my best results. And you can hopefully take that as well, just kind of double checking your work and trying to counter argue yourself. Sometimes, you're able to kind of come up with a closer estimate of intrinsic value of a business. So I hope that you'll check out the book Noise. The other book that I wanted to highlight is The History of the United States in 5 Crushes. This is a book that's really, really great. It's quite short, but it talks about 5 key crushes, and I think that this book is particularly helpful right now, and because it just talks about the sentiment that people have, investors have at a particular time, and how certain narratives just build up, and after a period of time they go away, and that it's okay. We will get through this. The United States continues to go ahead and continue to grow further, and the market will also get over this. So I think that's a good book to have. And the final book that I want to highlight, which is quite interesting for investment community, is the 50 Cent biography. So I think that this is a surprisingly good book. I don't care what you think about 50, but what the book is really insightful and inspiring is how you overcome setbacks. Obviously, 50 got shot several times and talks about that, but that's not really what the book is about. It's just how he went from being a rapper to being an executive producer in a. I'm not American, so there's a show in America called Power, which I didn't really know about, but how he negotiated like 150 million deal for Power on the Stars network. So the ability to kind of say, okay, in 2008, 2009, that people weren't really resonating with their music, with his music, and how to recognize that was obviously a setback, and how to go to a new industry and start again, and how to deal with. He talks about other rappers as well that had to deal with setbacks, and how to that it's absolutely normal to have setbacks, and you just have to kind of brush it off, and you kind of work it out, and you just go back at it again. So I think that that's kind of something that really helped me out, particularly during this period. That it's normal to have setbacks, and even if things are not going well right this moment, it's okay. So yeah, so this is all that I wanted to kind of talk about for today. I want to say thank you so much for your time. If you can, please drop me a like if you enjoyed this. It really motivates me to kind of keep coming out with new content, new ideas to kind of help and guide you through this turbulent investment period. Okay, thank you so much for your time. See you soon. Bye.